Welcome to the Options Trading Podcast. We're on a mission to empower individual investors with the knowledge they need. Join us as we break down complex topics into simple, step-by-step guidance for conservative options trading.
So if you're active in the markets, or maybe you're just starting to look into options trading, that whole leverage thing, you've probably hit this question. That seems basic, right? How many shares does one options contract actually represent?
Yeah.
But, getting this wrong, it's not just a small mistake. It can seriously mess with your capital, your risk, everything.
That is absolutely spot on. And that's really our mission today in this deep dive. We want to clear up any lingering confusion around this.
Okay.
Such a fundamental concept. And we really want to give you the solid knowledge you need to handle options contracts with, confidence. We're digging to the what, the why, and how it really impacts your trades.
All right. So let's just lay it out there. The short answer, the main rule for standard U.S. stock options.
Yep.
One contract equals 100 shares of the stock underneath it. That's the key number, multiplier. But why 100? Why not 50 or 1,000?
Well, it's actually kind of interesting history. Decades ago, when options trading was starting to become more accessible, not just for the big institutions, right, the exchanges needed a standard unit. Imagine the confusion if, one contract was 73 shares and another was 112.
Chaos, yeah.
Exactly.
Yeah.
So 100 was chosen as this sort of practical number. It was big enough to matter, to give you real leverage, but still kind of manageable for an average trader. It made everything simpler: pricing, settling trades, keeping records, and that standard just stuck, even with all the tech we have now.
And really understanding that 100 number is crucial for your actual trading account, isn't it? Let's use an example. Say you buy one call option on Apple, AAPL, maybe a $180 strike.
Okay.
If you decide to exercise that option, what are you actually committing to money-wise?
Oh, that's a big commitment. Exercising that single call means you have to buy 100 shares of Apple stock at $180 per share.
Wow.
So, yeah, do the math. 100 times a 180, that's $18,000 you need to have ready for just one contract.
$18,000. Okay.
And it's the same idea with a put option, right? You'd have the right to sell 100 shares at the strike price. It really shows the leverage you get. A relatively small options price controls a big chunk of stock value.
Okay, so that's the exercise part. But here's another thing that seems to trip people up all the time, even if they've read a bit about it, how the prices are quoted. You see a price, maybe $2.50 for an option. You might think, okay, $2.50, but that's not the whole story, is it?
No, absolutely not. And this is such a classic beginner trap. You have to remember that 100 share multiplier, that $2.50 quote, it's per share.
Right, per share.
So for the whole contract controlling 100 shares, the actual cost is $2.50 times 100.
Which is $250.
Exactly, $250 for one contract. And if you were buying, say, 5 contracts.
Okay, now you're talking $1,250.
Precisely. It adds up fast. So many traders, especially when they're new, they think they're placing a small bet, $2.50, and then boom, they realize the actual cash leaving their account is way more. Yeah. They can be a pretty expensive lesson in just basic options math.
Yeah, I can see that. Now, okay, 100 shares is the standard, the default, but the market isn't always perfectly clean. What about things like stock splits or special dividends, mergers? Do those just mess up the options contracts?
That's a really good point. And yeah, that brings us to what are called non-standard contracts. But luckily, there's a system in place, the Options Clearing Corporation, the OCC.
Big OCC, right.
They step in to make sure things stay fair when these corporate actions happen. So things like stock splits, reverse splits, spin-offs. The OCC adjusts the terms of the existing options contracts.
How does that work, like with a split?
Okay, say a company does a 2-for-1 stock split. Your old contract that controlled 100 shares might get adjusted. Now it could control 200 shares. But the strike price would also be adjusted, usually cut in half in this case, to keep the overall economic value the same.
Makes sense.
Sometimes these adjustments mean the contract covers an odd number of shares, maybe 87 shares or 125, or sometimes you might even get cash plus shares. It depends on the specifics.
So how do you know if you're dealing with one of these?
Have you ever wondered how professional traders pick their next option trade? Here's the secret. They use trusted signals from services like Option Picks. It's totally free. Just enter your email and wake up each morning with the top option trades vetted by pros. No guesswork, no stress. Just actionable trades to help you enter the market smartly. Head over to weloveoptions.com/optionpicks and grab your free daily trades. Try it. You might love how much time you save.
Well, usually your broker's platform will flag these adjusted contracts. They'll often have a different symbol or notation. But you can, and probably should, always double-check the contract specifications directly on the OCC's website. Definitely do that before you trade something that looks unusual.
Good tip. Okay, so far we've really been talking about options on individual stocks, but that's not the only game in town, right? What about, say, index options, like on the S&P 500, or options on futures? How do they fit in?
Right, vital distinction there. Index options, S&P 500, NASDAQ Q100, Russell 2000, those guys are fundamentally different. They don't represent shares.
Because you can't own a piece of the S&P 500 index itself.
Exactly. So these are cash settled. When they expire, there's no buying or selling of shares, no assignment. It's just cash changes hands.
Okay.
Your profit or loss is calculated based purely on the index's value compared to your strike price, and it's settled in cash. Much simpler in that regard, no shares involved.
And futures options, like on oil or gold.
Those are tied to their underlying futures contract. So one crude oil futures option, for instance, controls one standard crude oil futures contract, which itself represents 1,000 barrels of oil.
Wow. Okay. Big numbers.
Yeah. Or a gold futures option controls one gold futures contract representing 100 troy ounces. The point for you, the listener, is you always need to know the exact specs of what the option is based on. Is it stock? Is it cash settled index value? Is it a specific quantity of a commodity future? Because that defines your exposure.
And all of this, understanding the 100 shares for stocks, the cash settlement for indexes, the quantities for futures, it really boils down to managing your actual trading, doesn't it? Your risk, your position size.
Absolutely. It's foundational. These numbers aren't just trivia. Think about it. If a standard stock option goes up by $1 in price, that translates to a $100 gain per contract you hold. Why? Because it's 100 shares times that $1 move.
Right.
Conversely, if the option price drops by just 50 cents.
That's a $50 loss per contract.
Exactly. Now imagine you're trading 5 contracts, 10 contracts. Those small price changes get amplified massively by that multiplier.
Yeah.
If you don't nail down this math, you don't understand how much capital you're controlling and how much each tick is worth, you can see how accounts can get drawn down really, really quickly. It affects your position sizing, your risk management, even your margin requirements. It's all connected to that multiplier.
Okay, so let's tackle a question we hear a lot, especially from people newer to options. My call option is in the money. It's profitable. Should I exercise it? What's the typical answer there?
Yeah, that's a super common one. And the answer, maybe surprisingly for some, is usually no.
Usually no. Why not take the shares if you're right?
Well, it really comes down to capital efficiency. Mostly. The vast majority of options traders, they never exercise.
Really? So what do?
They do one of 3 things, typically. They sell the option contract itself back into the market for a profit, or they let it expire worthless if it didn't work out, or sometimes they'll roll the trade, close the current one, and open a new one further out in time or at a different strike.
Okay, but why not exercise if it's profitable?
Because remember our Apple example. Yeah. Exercising that one call meant tying up $18,000.
Right. A lot of capital.
A huge amount. By just selling the option contract, you capture its value, both the intrinsic value, how much it's in the money, and any remaining extrinsic value or time value.
Ah, the time value.
Exactly. Exercising throws away that time value. So unless there's a very specific reason, like maybe capturing a dividend right before expiration, selling the option is almost always financially better. Plus, think about it. Options allow for strategies like spreads, iron condors, credit trades.
Right, more complex strategies.
Yeah, and those strategies are designed to manage risk and be capital efficient without ever needing to own the underlying stock. That's kind of the beauty of options trading for many people.
Okay, that makes a lot of sense. So just to make sure everyone's got this crystal clear, let's do a really quick recap. What are the absolute must-know numbers and concepts we've covered?
All right, let's boil it down. 6 key takeaways for you.
1 standard stock options contract equals 100 shares. Always. Remember the multiplier?
Got it. 100 shares.
2nd, option prices, quoted per share, but your cost is that price times 100 per contract. Big difference.
Price per share, cost per contract.
Okay.
Think you need 8 screens, 5 hours a day, and a Wall Street background to trade options? Think again. The Options Traders Alliance is a free Facebook group where real people are building real income with simplified options strategies, including covered calls, naked puts, credit spreads, condors, butterflies, and more high-probability setups. You'll get tips, tools, and coaching from pros who actually trade what they teach. Join now at weloveoptions.com/free group and start trading smarter with people who've got your back.
Third, index options, like the S&P 500, no shares involved. They are cash settled based on the index value.
Cash settled, no shares.
Fourth, futures options. They control the specific size of the underlying futures contract, like 1,000 barrels of oil or 100 ounces of gold. Know the underlying
specs.
Yeah. Fifth, non-standard contracts. They exist usually after corporate actions like splits. They might have odd share counts. Always check the contract specs, maybe on the OCC site.
Check the specs, especially if it looks weird.
And finally, number 6, most savvy options traders don't actually exercise their options. They trade the contracts themselves. It's usually more capital efficient.
Trade the contract, don't necessarily exercise.
Yeah.
That's a great summary. So the bottom line here, really, before you click buy or sell on any option, you absolutely have to know your numbers.
You really do. Because, look, options trading, it's not, or it shouldn't be, a guessing game. It's math. It's working with probability. It's about controlling your risk.
Yeah.
And you can't control your risk if you don't know exactly how many shares you're controlling or how much cash value or how much commodity. You need to know how much each price tick is actually worth in your account, what your maximum potential loss or gain could be, and critically, whether the contract you're looking at is standard or one of those adjusted ones. Nailing this down, getting these fundamentals right, that's what lets you trade with, actual confidence and consistency. It helps you avoid those really common, painful mistakes that blow up accounts simply because someone didn't understand the basic multiplier.
So understand the numbers.
Understand the numbers, do the math, and you won't be one of those people caught completely off guard. You'll be trading with your eyes open.
This is an AI podcast based on educational material from Option Genius. Visit us today at optiongenius.com.